By the end of this video, you will know exactly whether buying a house in 2025 makes financial sense for your specific situation, and you'll have a clear decision-making framework you can use starting today to avoid the biggest wealth-destroying mistake of your life. Here's something that might shock you: the traditional advice your parents gave you about homeownership being the best investment you'll ever make. In 2025, that advice could cost you over $400,000 in lost wealth over the next 30 years, or it could still be the smartest financial move you ever make. The difference comes down to 7 factors that almost nobody is talking about honestly. But before we get to the one calculation that wealthy investors use to make this decision, a formula that most financial advisors never share with their clients because it doesn't earn them a commission, let's break down exactly what's happening in the housing market right now and why everything you think you know might be wrong. In this video, you're going to learn the true cost of homeownership that goes far beyond your mortgage payment, the rent versus buy math that actually works in today's market, and the 3 scenarios where buying in 2025 is genuinely a terrible idea even if you can afford it. Quick, if you've ever felt confused about whether renting is throwing money away or whether buying at these prices is financial suicide, hit the like button right now. It tells the algorithm this content is valuable and helps us reach more people who need to hear this before they make a decision that haunts them for decades. Let me paint a picture that might feel uncomfortably familiar. You're scrolling through Zillow or Rightmove at 11:30 at night, again, looking at houses you're not even sure you can afford. Your rent just increased for the 3rd year in a row. Your landlord is talking about selling the property. Meanwhile, your coworker just bought a house and won't stop talking about building equity, and your parents keep asking when you're going to stop throwing money away on rent. The pressure feels relentless. You've done the math a dozen times, but the numbers never seem to work out cleanly. The average home price in the United States right now sits at $420,000. In the UK, it's around £290,000. Mortgage rates are hovering between 6 and 7%, which means your monthly payment on that average home would be roughly $2,700 before property taxes, insurance, and maintenance. That's over $32,000 per year just in mortgage payments. And here's the painful part. Many people who bought homes in 2021 and 2022 are now underwater or barely breaking even, trapped in properties they can't sell without losing money. The dream of homeownership has become a financial nightmare for millions. But here's what nobody tells you. The question isn't whether buying a house is worth it. The question is whether buying a house is worth it for you, in your city, at your income level, with your specific timeline. And that answer requires understanding 7 critical factors that we're going to break down right now. The first factor is what I call the true cost illusion. Most people dramatically underestimate what homeownership actually costs. They see a mortgage payment of $2,000 and compare it directly to their $2,000 rent, thinking they're basically the same. This is a catastrophic mistake. Here's the real math. On a $400,000 home with a 6.5% mortgage rate and 20% down, your monthly principal and interest payment is around $2,023. But then add property taxes, which average 1.1% nationally. That's another $367 per month. Homeowners insurance adds another $150. Private mortgage insurance, if you put down less than 20%, adds another $200. Maintenance costs, which experts recommend budgeting at 1% of home value annually, add another $333 per month. Your actual monthly cost is now $3,073, not $2,023. That's over 50% more than the mortgage payment alone. Here's where most people get this wrong. They budget for the mortgage and forget about the water heater that dies in year 3, the roof that needs replacing in year 8, and the HVAC system that fails in year 12. The actionable fix is simple. When calculating affordability, multiply your mortgage payment by 1.5 to get your true monthly housing cost. If that number terrifies you, you're not ready to buy. The second factor is the opportunity cost calculation, and this next section changed everything for me when I finally understood it. Every dollar you put into a down payment is a dollar that isn't invested in the stock market. Let's run the numbers on a real scenario. Say you have $80,000 saved for a 20% down payment on a $400,000 home. If instead you invested that $80,000 in a broad market index fund, returning an average of 10% annually, in 30 years you'd have approximately $1.4 million. But wait, you say, my house will appreciate too. True. Historically, home prices appreciate at roughly 3 to 4% annually. Your $400,000 home might be worth $970,000 in 30 years. But here's the critical insight. You don't get to keep all that appreciation. You'll spend money on maintenance, repairs, renovations, property taxes, and insurance every single year. When you sell, you'll pay real estate commissions of 5 to 6% and potentially capital gains taxes. The typical homeowner captures only about 60% of their home's appreciation as actual wealth. The mistake 80% of people make is comparing gross home appreciation to net investment returns. The actionable fix is to calculate your expected net gain from homeownership after all costs and compare it honestly to what that same money would do in diversified investments. Factor 3 is the break-even timeline, and most people skip this step, so don't be like them. There's a magic number in real estate called the break-even point. The number of years you need to stay in a home before buying becomes financially better than renting. In today's market, with high prices and elevated interest rates, that break-even point has stretched dramatically. Using current numbers, the average break-even timeline in most major U.S. cities is now between 5 and 7 years. In expensive markets like San Francisco, New York, or London, it can stretch to 10 or even 12 years. Stop. Before I continue, this next part is critical. If you're not absolutely certain you'll stay in your location for at least 5 to 7 years, buying a house in 2025 is almost mathematically guaranteed to cost you money. Job changes happen, relationships change, life changes. The person who buys a house planning to stay forever and sells after 3 years typically loses between $40,000 and $60,000 when you factor in closing costs, real estate commissions, and the interest-heavy early years of a mortgage. The actionable fix is to be brutally honest with yourself. Write down every reason you might need to move in the next 7 years. If that list has more than 2 items, renting isn't throwing money away, it's buying flexibility. Factor 4 is the rent ratio reality check. There's a simple formula that sophisticated real estate investors use to quickly assess whether a market favors buying or renting. It's called the price-to-rent ratio. Take the median home price in your area and divide it by the annual rent for a comparable property. If the ratio is below 15, buying is typically favorable. Between 15 and 20 is a gray zone where personal factors dominate. Above 20 strongly favors renting from a pure financial perspective. Here's where it gets interesting. In cities like Austin, the ratio is currently around 22. In Phoenix, it's 19. In New York City, it's over 30. In parts of the Midwest like Cleveland and Detroit, it's under 12. The national average right now is approximately 18, right in that gray zone where the decision depends heavily on your individual circumstances. The mistake most people make is not checking this ratio for their specific neighborhood. National averages mean nothing when you're buying one house on one street in one city. The actionable fix is to spend 15 minutes on Zillow and local rental listings. Find 5 comparable homes for sale and 5 comparable rentals. Calculate your local price-to-rent ratio. If it's above 20, you need an extremely compelling non-financial reason to buy. If you've made it this far, you're already ahead of 95% of people. And what I'm about to share in this next section is the most valuable part of this entire video. Don't skip it. Subscribe to Wealth Decode Plus if you haven't already. We drop a brand new money strategy every single day at 6 p.m. Hit that notification bell so you never miss one. Factor 5 is the hidden wealth builder most people overlook. I need to pause here because this is where most people go wrong in the rent versus buy debate. Everyone focuses on appreciation, but there's a second way homeownership builds wealth that rarely gets discussed properly. It's called forced savings through amortization. Every month, a portion of your mortgage payment goes toward principal, which is essentially a forced savings account. In the early years, this amount is small, maybe $400 per month on a $320,000 mortgage, but it grows over time, and after 30 years, you own an asset worth potentially $1 million with zero debt against it. Here's the key insight. Most renters don't actually invest the difference between renting and owning. They spend it. Studies show that only about 23% of renters consistently invest their housing savings. The other 77% see lower monthly costs and increase lifestyle spending. So while the math says renting and investing wins, the behavioral reality is that homeownership forces discipline that most people don't naturally have. The actionable fix is to know yourself honestly. If you have the discipline to automatically invest the difference between your rent and what a mortgage payment would be every single month without fail, renting might be your path. If you know you'd spend that money on dinners and vacations, the forced savings of a mortgage might build more wealth despite being mathematically inferior. Factor 6 is the interest rate timing trap. Right now, mortgage rates are between 6 and 7%, roughly double what they were in 2021. Many would-be buyers are waiting for rates to drop before purchasing. This seems logical but contains a hidden danger. When rates drop significantly, more buyers enter the market. Increased demand pushes home prices up. You might get a lower rate but pay a higher price. Historical data shows that rate drops of 2% typically correlate with home price increases of 8 to 12% within 18 months. Here's a concrete example. If you wait for rates to drop from 7% to 5% on a $400,000 home, but prices rise 10% during that time, your new mortgage would be on a $440,000 home. Your monthly payment actually goes up by about $80 despite the lower rate, and your down payment requirement increases by $8,000. The mistake is waiting for perfect conditions that may never align favorably. The actionable fix is this. If you find a home you can afford at current rates in a location where you'll stay long-term, seriously consider buying. You can refinance when rates drop, but you can't unbuy a house that increased $40,000 in price. Factor 7 is the 3 scenarios where buying in 2025 is genuinely a terrible idea regardless of everything else we've discussed. First, if your job security is uncertain or you're in an industry facing disruption, buying anchors you geographically at the worst possible time. Second, if buying would require more than 30% of your gross income for total housing costs, you're setting yourself up for financial stress that compounds over years. Third, if you haven't maxed out employer retirement matching, buying a house before capturing free money is leaving guaranteed returns on the table. But here's what nobody tells you. There's also a psychological cost to homeownership that doesn't show up in any spreadsheet. The stress of major repairs, the anxiety of being underwater on your mortgage, the feeling of being trapped when your dream job opens up in another city. For some people, the freedom of renting is worth paying a premium, even if the math says otherwise. Now let's talk about exactly what you should do with this information. Today, within the next 10 minutes, I want you to calculate your local price-to-rent ratio. Pull up Zillow or Rightmove, find 3 homes similar to what you'd want to buy, and find 3 comparable rentals. Divide the average purchase price by the annual rent cost. Write this number down. This week, Do 3 things. First, get pre-approved for a mortgage even if you're not ready to buy, because this tells you your real purchasing power and what rates you'd actually qualify for. Second, create a true cost budget by multiplying the mortgage payment by 1.5 and seeing if you can comfortably afford that number. Third, honestly assess your 5-year timeline, and if you can't commit to staying put for at least 5 years, put the house hunt on hold. This month, set up a system. If you decide buying isn't right for you now, open a high-yield savings account or brokerage account and automate transfers of the difference between your rent and what a mortgage payment would be. Name the account something like Future Home Fund or Wealth Builder. This way, whether you eventually buy or keep renting and investing, you're building wealth intentionally. Free tools that can help include NerdWallet's Rent versus Buy Calculator, which lets you input your specific numbers for a personalized break-even analysis. The New York Times Rent versus Buy Calculator is another excellent option with more detailed inputs. For UK viewers, Money Saving Expert's Mortgage Calculator and their rental yield calculators provide region-specific insights that account for stamp duty and other UK-specific costs. Now, let me answer the question I planted at the very beginning. The calculation wealthy investors use that most advisors never share. It's called the total return comparison, and here's how it works. Take the total amount you'd spend on housing over 10 years if you buy, including down payment, all mortgage payments, taxes, insurance, maintenance, and eventual selling costs. Then calculate what you'd spend renting a comparable place over the same period, plus what you'd earn by investing the down payment and monthly savings difference. The scenario with the higher net worth at the end wins. When I run this calculation for most major cities in 2025, renting and investing wins in expensive coastal markets, buying wins in affordable Midwest and Southern cities, and it's essentially a tie in mid-priced suburbs, making lifestyle factors the deciding element. Here are your 3 key takeaways. First, your true monthly home ownership cost is roughly 1.5 times your mortgage payment, so budget accordingly. Second, if you can't commit to at least 5 to 7 years in one location, renting is likely the smarter financial choice. Third, the price-to-rent ratio in your specific area matters more than any national trend or headline. Comment below and tell me which of these 7 factors surprised you the most and what you're leaning toward now, buying or renting. I read every single comment and I'll personally reply to as many as I can. In tomorrow's video, I'm revealing the exact strategy for building wealth as a renter that most people never discover. A system that took me years to figure out and can actually make you richer than most homeowners. Subscribe right now so you don't miss it.